All right. Well, then we're going to go ahead and get started. Those of you that are joining us here today, I'm Joe Lucey with Secured Retirement Financial. We got a special guest here today, Andy Ives with Ed Slott's organization. And welcome to this week's Huddle. You know, there's some legislation that was just recently passed. It's going to go into effect here tomorrow on June 30th, and it's called Regulation Best Interest. And kind of a little bit of a background behind this. You know, a lot of folks have been finding themselves with the coronavirus and what have you unemployed. SEC has seen, and actually it goes back farther than this, but kind of I think that bringing it full around here right now has to do with the SEC seeing some abuses out there, mostly with the transactional brokers around having people move money around in their IRAs and 401ks, maybe without their best interests always in mind. Of course, here at Secure Retirement Financial, we're certified. I'm a certified financial planner. We're held to the fiduciary standard. We're also registered investment advisors as fee advisors. So we are held to a higher standard that now they are bringing a lot of the other transactional brokerage firms to, again, starting tomorrow. In fact, in the SEC regulation here, they mentioned IRA rollovers 78 times. So it's definitely something that's on the radar, something that we've seen a lot of times. And one of the reasons actually that we're members of the Ed Slott organization is to make sure that we are helping families making the right decisions around that. So today's Market Huddle, I've got Andy Ives. He's a subject matter expert, over 20 years experience. He's actually my go-to guy when I have a question around more complex IRAs. In fact, maybe if we have time, Andy, we can even talk about that one interesting situation I was just talking to you about, that Andy was able to get the right answer for us to, which I think that even, anyway, so we're very fortunate, and that's one of the reasons that we are Ed Slott lead advisors, to have the expertise of somebody like Andy. So with that said, again, the reason for today's call, the do's, don'ts, and dangers of rolling over your 401ks into IRAs, has to do really with the more and more families that are now starting to find themselves losing jobs because of the coronavirus, and the attempt by the industry to bring everybody up to the right standards to make sure that they're holding their obligations to the public in a fiduciary manner. And again, this new regulation that goes into effect tomorrow, which is going to start to regulate that, where they mentioned IRA rollovers 78 times. With that said, Andy, welcome to today's Joe Market Huddle here.
All right, thank you very much. I appreciate that.
Let me see if I can get the slides going here, and then what we'll do is hopefully we all see that. And then what I'm going to do, the do's and don'ts and dangers of rolling over, we're going to try to keep this here today to about 15 minutes. This is that normal disclaimer. I'm not with Ed Slott's organization, although I've been over a decade, I think 12, 13 years now, an elite advisor with them. But also keep in mind, we're going to talk about some tax things. We're going to talk about some estate planning things potentially here. We are not attorneys, we're not CPAs, and so forth. So with that said, Andy, I'm going to shoot it over to you now, and I'm going to actually duck out here from the video.
Okay. All right. Well, I appreciate that, Joe. Yeah, it's amazing to me that we have to have a Reg BI regulation best interest. As a person who's a CFP and have been in the industry for over 20 years, I have always tried to practice regulation best interest, and I like to work with advisors that do practice regulation best interest just naturally. But unfortunately, a lot of folks don't subscribe to that, so we needed this extra law. Anyways, so Joe talked about rollovers. They're a super popular topic these days for a number of different reasons. But it's a lot more than just moving money from one account to another. And I'm talking about from 401k plans or work retirement plans to an IRA. When I say 401k, I mean like 403b, 457. So I'm just going to lump that under 401k for the ease of conversation. But it's more than just moving money from a 401k to an IRA. Anybody can do that. It's an easy transaction. But do they understand the ramifications of that transaction? Do they understand the possible tax benefits and things that they can do during that transaction? What is available to them from a tax subject matter? Again, we're not just moving money from like a savings account to a checking account. We're making what I think are potentially lifelong and sometimes, and we'll see this, sometimes irrevocable decisions with a rollover. Now, I certainly don't want to scare anybody when we're talking about a rollover. It's just something that needs to be thought through before you do it. So what I've done here is made this very simple. I've got 3 sections. I've got first section is reasons to leave money in a 401k or in a workplace plan. Next section is things to consider while that money is in transition. And then the final section is benefits of having an IRA. So you can see on the first page there, reasons to leave money in a company plan. And I've listed a couple of them here. One of them is federal creditor protection versus state law. So when you are in a 401k plan, you have the biggest shield possible against creditors. And I'm talking about like if you lose a lawsuit against someone. So picture the doctor that faces a malpractice lawsuit. When that money is in a 401k, it has the gold standard of protection from ERISA, which is the Employee Retirement Income Security Act. You've probably heard of ERISA before. That offers the protection within the 401k plan. So if that advisor loses a $2 million settlement, those $2 million, or whatever he has in his retirement plan, are shielded from those creditors. Compare that to an IRA. It says there, federal creditor protection versus state law. Every state is different. Some states will offer protections that are comparable to ERISA. Some states, not so much. So it is imperative to know what your state offers if you are concerned about creditor protection, if you're considering a rollover. So I get back to that doctor example. If he was facing a malpractice lawsuit and also considering a rollover and knew that he was in a state that did not offer great federal creditor protection at the state level, might want to reconsider that rollover and might want to leave it in the 401k until that lawsuit is settled. Next one, unlimited bankruptcy protection. I put a bunch of question marks after this because some people think that there's a big difference between the two, IRA versus 401k. There is a difference. 401k, once again, great protection. The gold standard of shields, fully protected in bankruptcy. If you lose an $8 million loss, if you file for bankruptcy and you've got $8 million in judgments against you for bankruptcy, that money is protected in the 401k. What about an IRA? An IRA does have some protections. It's actually an inflation-adjusted cap. That current level is $1,362,800. So $1,362,800. That is based just on contributions and earnings within that 401k. So it's a good number. I've done the math. If you contributed the maximum amount to an IRA every year since IRAs were first created, and if you add in earnings of, let's say, 6 or 8%, you would not be at that cap. So it's a good number. The reason I put question marks after that as far as unlimited bankruptcy protection, the question always comes up, well, what if I roll money from my 401k to my IRA? What about the protections there? What's nice is the bankruptcy protection is picked up by the bankruptcy code in the IRA. So you keep that, let's say $8 million of protection, whatever you had, those $8 million stay protected in the IRA, and they do not count against that $1,362,800 cap. So 2 different things. You don't have to keep those dollars separate in the IRA. Just be aware that unlimited protection, bankruptcy protection in a 401k, that protection carries over. It's picked up by the bankruptcy code, and you still have the $1,362,800 in the IRA. The still working exception is a big one. That's the 3rd bullet point. This applies to 401k plans, but does not apply to IRAs. If you are, say, a 72 or 73 or older person, and you are still working, and you are adamant that you do not want to take a required minimum distribution, you may not have to. The still working exception is not a requirement on plans. They do not have to have it, but a lot of them do put that on there as a feature. Basically, what it says is that if you are still working, you do not have to take an RMD from the plan. So if a person has a 401k, and let's say they're 73 years old, and they also have an IRA, they would have to take the RMD from the IRA, but they do not have to take it from the 401k until the year they retire. You can work till you're 80, 85, and not have to take an RMD from a plan. So that's one reason why people would stay in a plan, possibly. And then the last one on there is the age 50 and age 55 exception. This is, it's a way to pull money out of a plan if you are under 59 and a half. and it's based on your retirement or separation from service age. If I turn, I'll use the 55 exception as an example. If I turn 55 and I retire in the year I turn 55 or later, I can take withdrawals from that plan and not have a 10% penalty to worry about until I'm 59 and a half, and I can move the money to an IRA, and that penalty would never apply anyways. So the age 55 exception is a reason to leave money in a plan. You can gain access to it if you retired at age 55 or later. That does not apply to an IRA. If a person retired at 55 and rolled their money to an IRA, they are bound by IRA rules, and the age 59 and a half, they'd have to get 59 and a half before they could pull those dollars out unless another exception existed. So there's a couple of points as far as why it might make sense to leave money in a plan. I've got 2 bullet points here as far as, okay, you've decided you're going to move the money to an IRA. Here's some things to think about while the money is in transition, or actually before you actually pull that trigger. First one, net unrealized appreciation, or NUA. This applies to company stock in the 401k, and it's got to be the company stock for the company that you work for. So let's say you work at Target and you're a member of the Target 401k plan, and you've got Target stock in your 401k, or you work for 3M and you've got 3M stock in your 401k. As an example, let's say you had $1 million of Target stock in your 401k. You had a basis of 100 grand, that's what it cost you, and you've had $900,000 of appreciation. You've been with that company for a while. If you did a normal withdrawal, you didn't worry about NUA, you'd have to pay ordinary income on $1 million because it's all pre-tax money in the 401k. If you roll that $1 million to an IRA and then did a withdrawal, same thing. You're going to own ordinary income on $1 million. If you processed an NUA transaction, and Joe and his team can certainly walk you through to see if you're eligible or if you're a good candidate, but you could take that $1 million of Target stock out, put it into a regular brokerage account. You would only have to pay ordinary income tax on the $100,000 basis, and the $900,000 in earnings would be taxed at long-term capital gains rates. If you jumped the gun and did not know about NUA, if you were not advised properly, if you moved the money to an IRA and you did a rollover without doing NUA, you have killed that NUA transaction forever. So definitely something to consider if you have highly appreciated company stock in your 401k. Roth conversions is another one. 401k plans have a way, they can separate money. Some plans have after-tax dollars in them and pre-tax dollars. I don't mean Roth, I mean actual after-tax dollars that are not Roth. When you're doing a rollover to an IRA, you can split those dollars. You can move the pre-tax to an IRA. You can roll the after-tax to a Roth. It's a clean way to separate dollars. It's a tax-free transaction conversion basically to the Roth because it's only after-tax dollars. If you did it improperly and you sent all those dollars to the traditional IRA, it's going to be a mess. You're going to have basis. You're going to have pre-tax dollars mixed with after-tax, pro rata rule, and a whole bunch of other mathematical things come into play when you want to do a Roth conversion later on. So 2 things to consider while the money is in motion. Next slide here is benefits of an IRA. So, all right, you're in your 401k, you've weighed the pros and cons, and you want to move to an IRA. These are probably some of the reasons why you want to move. Estate planning. Certainly estate planning is easier with an IRA versus a 401k. And I say that from a standpoint of beneficiaries. With an IRA, I can split my IRA if I want. I can split it into 2. I can name 1 beneficiary on this one. I can name 3 beneficiaries on this one. I can keep it as 1 and name 3 or 4 or 5, name whoever I want as a beneficiary on my IRA. With a 401k, you're typically required to name your spouse unless that spouse signs a waiver. So not as much flexibility as far as estate planning on a 401k. Investment options. For those that have been members of a 401k, you probably are aware when you go in and you click on what you can invest in, you get a couple of different funds in each different asset class, maybe some target date funds in there. You don't have the universe of investments available to you by any stretch of the imagination. If you do a rollover to an IRA, now Joe and his team can look at the entire spectrum of funds to pick from and identify the best, most suitable options for you and your situation. So investment options is a reason to move. Consolidation and control. This is just a function of I think, eliminating confusion, paperwork, statements, different RMDs. If you have a person that just happens to be a member of two plans, maybe they worked at a company, had a 401k, left that company, went at a new company, became a member of another 401k plan, and then retired, and now they have an IRA. So they've only got three different plans, three different items, two 401k plans and an IRA. But when they're old enough, 72, they're going to have an RMD from one plan, an RMD from the other plan. They're going to have an RMD from the IRA. They're going to get statements from all those, different investment options in the one plan versus the other. There's no reason to have that mess. You can certainly roll everything over into the IRA, consolidate, take control, minimize the paperwork, one RMD, a lot easier. No withdrawal restrictions is the next bullet point. Some plans make it super difficult to get at those dollars. You have to either hit a certain age, 59 and a half. They might not have in-plan withdrawals. IRAs have no such restrictions. You can always get at your dollars. Even if you're only 50 years old, you can get at those dollars. There may be a penalty, but you can still get access to those dollars. Second bullet point from the bottom, QCDs, qualified charitable distributions. They are not available from a 401k. If you are a charitably minded person and you want to do a QCD and you only have a 401k, you can't do it. You would have to do a rollover to an IRA and then process the QCD from the IRA. So that's one reason why people will move. And the last one I have on there is simply expert advice. I know that when Joe and his team and other advisors have access to everything, they can see everything, they can make decisions on everything. Oftentimes the 401k, it's not under their purview. They might not know it's out there. They might not be told that it's out there. If you bring everything together, the advisor, the person that you trust with your dollars, can look at the entire picture and formulate the proper plan. So again, high level conversation there about benefits of keeping money in a plan, things to consider while it's in transition, and then certainly benefits of an IRA over a 401k. If there's any questions on any of those things, I'd be happy to take them.
That was great. Thank you. So I don't see any questions coming in. Does anybody have any questions for Andy today during this? I'll tell you, probably the two biggest areas that we're seeing where there's a loss of opportunity usually has to do with either the net unrealized appreciation that Andy talked about, the example with using target stock, and I know that there's one or two of you that are on here that have actually participated with NUA with target stock, but it can be Honeywell. We've seen it with 3M. We've seen it with Delta. A lot of the publicly traded companies around here, Medtronic. So NUA is really one that you want to make sure that you're looking at when you're doing that. Number two, the other area is when we have somebody that might be retiring a little bit before age 59 and a half. Somebody's retiring or lost their jobs at 57. As soon as we roll that money over into an IRA, from the 401k, we're now going to be stuck with either a 10% penalty, or the other option is what the equal periodic payments, what they call 72T. The problem with the 72T is it really kind of locks us up here a lot of times. And I know that some of you in here have came to us after already starting a 72T, and we've heard it a lot that they wish they hadn't done that. One option would be to maybe do a partial rollover, leave some money in the 401k. Again, if you got that NUA stock, it's going to be a little harder to do that. So there's a lot of reasons that you got to make sure that you're working with an expert on this. Something that's important to all of us here at Secure Retirement Financial. That's why we are associated with great groups like the Slott organization, and pay and make the commitments to be a part of the ongoing training through them. So that's a couple there. I do want to talk about another one. Let's see, how does a qualified charitable distribution work? I can probably answer that, but then Andy doesn't have any good reason to be on here. So Andy, I'm going to let the expert answer that one.
Yeah, a QCD is a way to move money directly from an IRA to an eligible charity, and that money is excluded from income. So you typically see it, you've got to be 70 and a half. A person must be 70 and a half years old to actually process a QCD. So you typically see it with RMDs, a required minimum distribution. Let's say a person has a $10,000 RMD. They can do a $10,000 QCD. The money moves directly from the plan, or excuse me, from the IRA. The custodian will send that to the QCD. It satisfies the RMD requirement, but that $10,000 is not included in their income for the year. You have up to $100,000 annually that you can do. You can do as many QCDs annually as you want, up to that $100,000 level. But they're, very popular among folks that are doing RMDs.
Quick question on that, Andy. That's $100,000 per taxpayer or per tax return?
Per person, per individual.
So married couples can actually do a qualified charitable distribution of up to $200,000 in any 1 year, correct?
That's absolutely correct.
You know, one thing about the QCDs, and we've done a lot of those here with a lot of our clients, and some of you I know that are on here are doing qualified charitable distributions as part of the planning we do. The 1099 you get from a QCD looks just like a 1099 that you would get as if you took an RMD or required distribution, or, you know, to pay for lunch with the money. So you want to make sure you're keeping track of that and work with your tax person. Let them know that the money went to a qualified charitable distribution. There's nothing worse than doing the right thing by doing the QCD and then not getting the tax credits for it. So that's something you want to make sure you're looking at there and keeping track of. That's one thing that we do for our clients. We make sure that we send them a follow-up letter at the end of the year to bring to their tax person. I see something here about NUA regarding Cargill. Cargill is a private company, and Cargill's plan does not allow us to do a NUA. That is one of the things that we're seeing. A lot of Cargill employees do not do the qualified or don't do NUA, and they end up holding their, because Cargill's been a great performing stock. I think this year the stock has actually gone down for the first time in a while. Somebody correct me if I'm wrong on that, but NUA is hard to do out of Cargill, and I think it's outright impossible to do with the plan limitations, and it's so the way that works.
It doesn't work for everybody. It's not a perfect fit for everybody. But yeah, that's a shame if a good company like that can't get it done. But it's up to the plan. One of our phrases, the law of the plan is the law of the land. There's nothing you can do to fight it sometimes.
And Dave asked a question here about tax bracket considerations. Now, I'll let you kind of pipe in on this a little bit too, Andy. But, you know, the one thing that we are always talking about with clients is to keep in mind that the tax brackets, the way that they work is that we're a marginal tax bracket. It means that above certain thresholds, you start paying higher tax, but it's only on the money about that. But keep in mind that right now our tax brackets are 10%, 12%, and then it jumps all the way up to a 22% bracket. It's an 88 or 80% increase there. 22 to 24, which we can get into the mid $300,000 income range, is not a very big jump. But then again, we start jumping into the 32% bracket. So really what you want to be looking at is making sure you're working with somebody that's doing some smart look forward tax planning to start to dial in what those are at. A lot of times we will use something like a QCD so that we can actually satisfy the RMD and still be able to not have to take income, which can allow us to do more conversions down the road. Another thing we can look at if you're charitably inclined is like a donor advised fund or even some just charitable gifting. So there's a lot of different things we do there. Change the required minimum age. Sharon, yes, they did. They raised the age to 72. So unless
but not on the QCD, which is crazy. So the RMD age is 72, but the QCD age is still 70 and a half, which is a little bit clunky, but that's the way it is.
And that's a true 70 and a half, isn't it, Andy? Because I know that that's where we've seen some mistakes. Somebody will take that QCD, try to do that at age, you know, right when they turn 70, but you actually have to be 72 and a half. So your birth date plus exactly 6 months, 180 days to do that QCD. If you do it any less than that, they're going to consider it a regular distribution.
Yep, 70 and a half. Yeah, like you said, true 70 and a half. Got to be that age. And that same thing applies to inherited IRAs. The person has to be, like if I inherited an IRA from a grandfather who was 70 and a half and doing QCDs, and then I inherited it and I was only 50, I can't do it until I'm 70 and a half, even though my grandfather was 70 and a half when I inherited the IRA from him. So it's a true 70 and a half for the account owner.
You know, Dave, I'm not sure. I'm looking and I'm bouncing around here, I guess, a little bit on the chat here, folks. But Dave asked a question about okay to use conversion dollars to also pay taxes involved. Yeah, you can pay conversion dollars. Sometimes I'll hear that doesn't make as much sense, but it really depends on where you think taxes are going, in my opinion. I'll let Andy pipe in here too.
Yeah.
But if you think that taxes are going to be higher down the road, actually using some of that planned dollars to pay the tax can make some sense. And we've got some software, we've got some the ability to show you how that would work for you specifically, so you can make your own specific customized so we can make some recommendations customized to your own planning.
Yeah, I would agree. Everybody's different. Where I see some people make mistakes is that if you're under 59 and a half and you do a Roth conversion, which is I think what we're talking about here, that money and if you pay the taxes from the money in the IRA, that money never actually gets converted, and it's basically a withdrawal that gets sent to the IRS. So if you're under 59 and a half and you do a conversion, you're actually going to pay a penalty on the taxes that go to the government because you're under 59 and a half. So for younger people, definitely pay the taxes from another source. We like to see people pay the taxes from another source regardless, because that way you get the full amount over to into the Roth. You get the full amount working for you, but not everybody can do that. So like I said, every situation is different.
Let's see if there were any other questions here. If not, an interesting thing about Andy, we had you on about 3 weeks ago, 4 weeks ago?
Yeah, it was about 2 or 3 weeks ago.
3 weeks ago, and since that time, they have made some changes, and Andy let us know this. Actually, the Slott organization did. See, up until a few weeks ago, actually up until about 10 days ago, they allowed us, if everybody knows that there are no required minimum distributions for 2020 for anybody. However, had you taken a required distribution in January, you were not allowed to put that money back. That has been changed as of about 10 days ago. We actually ran into an interesting situation, and I know that the client of ours who this kind of, so to keep anonymity, we aren't going to talk about any names here, but their father had become ill, had a heart attack, and in February they did a required distribution, and then they did a Roth conversion with that money. They did the Roth conversion for a couple different reasons, but it made sense in their situation. Both our client, he's had some siblings that are all in higher brackets, and dad was in a lower tax bracket. So let's get the money moved over into a Roth IRA. Well, to do that, they had to take a required distribution. Well, then they come out with this ruling here 10 days ago that allows us to put those required distributions back. So the question is, can they do that? Now, Andy went to work for us here over the weekend, came back to me first thing this morning. He said, Joe, the good news is that your client probably could put that money back into their deceased father's IRA because there was no RMD needed. The problem is this: we can no longer do the Roth conversion. So it would make sense in that. But that's a real reason why we have partnered with Ed Slott's organization, why Andy's such a valuable member of ours, because to get that answer, I don't know how we would have been able to find a authority out there that would have given us that answer. Literally, I asked Andy at about 3 o'clock on Friday afternoon. He had that answer for me here first thing this morning. And they're probably even some of the higher tax attorneys out there would probably not have been able to get back to us with that answer that quick. So, Dave, we're going to answer one more question, then we'll kind of wrap things up. What if over 65 and doing the Roth conversion? Keep in mind, Dave, the one thing you're going to want to be careful of around age 65 is whenever you actually about age 63, in many cases 63, 64, is IRMA, income related to Medicare adjustment amounts. That means that when our adjusted gross income gets above certain thresholds, we get to pay higher Medicare premiums. So Dave, when you're asking about age 65, first thing that comes to mind for me is Medicare. There's nothing wrong with doing Roth conversions. We do a lot of Roth conversions in what we call the golden decade, age 59 and a half to 70 and a half, that period of time when many people are retiring. But understand that at 65, we got to start worrying a little bit about additional premiums that might have to get paid there. Andy, any other thoughts on doing a Roth conversion at age 65 or older?
No, you're on it. We call them stealth taxes. So yeah, I mean, you can get bit by the IRMA surcharges. Also, another thing that people don't think about is if they're subject to financial aid. Maybe they have a certain amount of income that they have, and their son is college age and going to school, and they're getting financial aid. All of a sudden, they do a Roth conversion, and it boosts their income up over the threshold for financial aid, and they lose the financial aid. So certainly more to like a rollover, more to a Roth conversion than just moving money from an IRA to a Roth.
Yeah, the other thing is even if there is going to be a little bit of a higher Medicare premium, sometimes we'll actually recommend it for some families. If a married couple is in our office and one of them has some health issues, keep in mind there's also widows. We did. Andy talked about the stealth tax. There's also torpedo taxes, but there's also widows and kiddos taxes. Widows pay higher premiums or taxes than married filing joint. The kiddos might pay the tax at a higher rate than you. So that doesn't necessarily mean that paying a little extra premium doesn't make sense in your situation. Again, the reason why we offer our 15-minute strategy session is to kind of go over these specific situations for you. In fact, I'm going to forget if I don't mark it here. So if you would like to take it up and schedule 15 to 30 minutes with one of our advisors here, you should see a way to do that right now. We can get you on the calendar automatically there. And we can take advantage of that if that's something you'd like to do. Again, I want to thank every one of you that are current clients. We're seeing more and more families in the last 60 to 90 days than I have seen in the last 5 years. We've always had a lot of referrals from clients, but I think that the calls we're doing here, these weekly calls and what have you, I think that there's a lot of value there. And we're getting more and more families that are referring us on to other friends of theirs. If you're looking to share this information with somebody, just feel free to pass this on to the link. We're going to do a follow-up on this and have them join us for one of these. And if there's enough value there, sometimes it makes sense for somebody to take us up on this 15 to 30-minute call. One more answer here. Peter, I heard that the converted money has to go to the Roth, and part of it cannot be used to satisfy tax liability. Tax liability must come from other funds. Andy, you kind of answered that earlier, but go ahead and I'll let you reiterate.
You can have money withheld from your conversion. If I've got $100,000 and I want to say 20%, please withhold 20% for taxes. I'm only going to be converting 80,000 and 20,000 is going to go to government for taxes. You are certainly allowed to do that. Or you can say zero withheld, or whatever number you want. I think zero is the way to go. All $100,000 goes to the Roth, but then when you do your taxes the next year, you're going to have to pay taxes on that full $100,000. So you're going to have the money available someplace to pay for that conversion. And you can't undo it. If it turns out you don't have that money, you're going to have to find it from somewhere, because you can't go backwards on a Roth conversion.
With that said, Andy, I really want to thank you for joining us again here today. Hopefully everybody that joined us got some value out of this. Feel free. We're going to get you out the replay of this. If you want to pass this on, let other families, don't make us, keep us a secret. If you've got other friends or somebody that's having questions, maybe they're not getting this advice from their current, where they're currently getting their financial information, have them join us. Let them sit in on a couple of these calls and maybe after listening to one or two of them, they decide to join us for a 15-minute review. That'd be great. So with that said, that's all we have. Andy, I want to thank you again for joining us. And I hope everybody else enjoys the rest of their week. It's kind of drizzly here today, but it looks like the rest of the week and the 4th of July are going to be wonderful. So we hope everybody else has a great Independence Day here this weekend. Thanks again, Andy.
Thanks, guys.